Ever tried to read a Wall Street analyst report? It can feel, well, like it's written in a totally different language. Super dense, a little intimidating, and just packed with jargon. So today, that's what we're going to do. We're going to translate one. We've got a real Goldman Sachs report right here, all about the AI boom, and we're going to break it down piece by piece so you can see exactly how these pros build their case. Ready? Let's dive in. Okay, so this single sentence right here, this is basically the whole story. It's the entire argument all wrapped up in a nutshell right in the title. So our job is to unpack every single piece of this phrase. We're going to figure out what it all means, and more importantly, how it all led Goldman to slap a buy rating on this thing. All right, first thing you got to know about these reports is they're kind of built upside down. Think of it like an inverted pyramid. They don't save the big reveal for the end. Nope, they give you the conclusion right up front. And the rest of the report? That's just all the evidence to back it up. So let's look at Goldman's conclusion here. So let's start with the before picture. We're talking about a company called Shannon Circuits. Before this report came out, Goldman had a 12-month price target. That's basically their prediction of where the stock will be in a year of 132 renminbi. And now, the after. They've bumped that target all the way up to 150. And look, that's a pretty significant jump. Whenever you see an analyst raise their price target like this, it's a huge signal. It's them telling the world, hey, we're a lot more confident about this company's future than we were before. And just to make it absolutely crystal clear, they stamp it with their official rating, buy. It doesn't get much more direct than that. It's a clear signal to all their clients that they think this stock is a solid investment. So, the big question is, why? What did they see that got them so excited?
And that brings us right to the heart of the argument. You know, the reason for all this optimism? It's not really about just one company. It's about a massive global trend, the absolutely insatiable demand for the hardware that makes AI tick. Which, of course, leads to the next logical question, right? If the AI boom is the why, then what's the what? What part does this company, Shannon Circuits, actually play in this whole tech revolution? Well, they make PCBs. That stands for printed circuit boards. The easiest way to think about them is like the central nervous system for any piece of electronics. They're the green boards that connect everything together. Now for your toaster, you need a simple one, but for massive high-powered AI servers, you need some seriously advanced stuff.
And that right there is Shannon's sweet spot. They don't mess around with the simple stuff. They build the really complex, high-end boards that are absolutely essential for the most powerful AI hardware out there. You know, the servers that are doing all the heavy lifting, and the high-speed switches that let them all talk to each other at mind-bending speeds.
So what you have here is a classic Econ 101 setup, and this is exactly what Goldman's analysts are keying in on. The demand for these high-end AI parts is just exploding, but the supply of these super specialized PCBs is really tight. So you've got everyone wanting them, but there just aren't enough to go around. And for a company in that position, that is a very, very powerful place to be.
Okay, so how does all that turn into a financial argument? I mean, how does this supply and demand problem actually translate into cold, hard cash on a company's balance sheet? Let's get into the numbers.
The report points out this really interesting tension. On one side, the company is feeling some pressure. The raw materials they need to make these boards, things like gold and copper, are getting more expensive. Now, normally, that would crush your profits. But on the other side, you've got this incredible tailwind from the insane demand for AI hardware. And that strength leads to a really crucial idea in the report, resilient pricing. Basically, because customers are so desperate to get their hands on these high-end parts for their AI projects, Shannon doesn't have to get into price wars. They don't need to offer big discounts. They can keep their prices stable. The report even says they see slower price erosion than normal, which is analysts speak for they can pretty much pass on those higher material costs directly to the customer. And here's the payoff. Because of that pricing power, the analysts feel a lot better about the company's future profits. So what did they do? They officially raised their net profit estimates for the next few years by 1 to 3%. Now, I know that might not sound like a huge number, but trust me, in the world of Wall Street finance, that is a really meaningful upgrade. Okay, so the company's future looks pretty bright. But that's only half the equation, right? The final piece of the puzzle is all about valuation. Is the stock's price a good deal right now, or are you overpaying for that bright future? To figure that out, analysts use tools like the PE ratio, price to earnings. The simplest way to think about it is like a price tag for a stock. It basically tells you how many dollars investors are willing to pay today for just $1 of the company's profit. So a really high PE might mean a stock is expensive,
and a low one could mean it's a bargain. But, a PE ratio by itself is pretty meaningless. You need context. So analysts look at its history. In Shannon's case, investors have historically paid anywhere from 19 times its earnings on the low end to 39 times on the high end. The average is right around 29. So that range gives us a yardstick to measure against.
And here is the kicker. Right now, the stock is trading at about 28 times earnings. See that? It's just a little bit below its historical average. And that is exactly why the report calls the valuation undemanding. In other words, for a company that's plugged into the huge AI growth story, the price tag doesn't seem crazy at all.
All right, now no analysis is ever complete without talking about the risks. What could go wrong? A good report is never just a sales pitch. It's supposed to be a balanced look. And that means being upfront about the potential downsides and, yeah, all that intimidating fine print at the end.
And the analysts here are pretty clear about the potential pitfalls. I mean, what if this whole AI boom suddenly cools off? Or what if geopolitical issues mess up the supply chain? Or maybe new competitors jump in and start a price war? These are the big what-ifs that could totally sink the whole argument.
And that brings us to the part that, let's be honest, almost everyone just scrolls right past. Those pages and pages of super dense legal text and disclosures. It looks scary, I get it, but what is all that stuff actually for?
Well, the reason is actually pretty simple. It's all about transparency. That fine print isn't there to trick you or hide something. It's there so the bank can be totally open about how it operates and to disclose any potential conflicts of interest, which are just a normal part of their business.
You can basically boil it all down to a few key points. First, the analyst signs their name to it, saying, yep, these are my genuine opinions. Second, the bank says, hey, just so you know, we might do other business with this company. And finally, they give you the classic reminders. Past performance is no guarantee of future results. And hey, this report, it's just one data point, not a complete financial plan.
And that all leads us perfectly to this final quote, which is pulled directly from the report itself. And honestly, it's probably the most important takeaway from this whole explainer. An analyst report is an incredibly powerful tool. For sure, it helps you understand a company and industry, but it is not a crystal ball. It's a starting point for your own research, for your own thinking. It's never the final word.